stock market has just opened and we pretty much see red right across the board, and it is going to be an important week here, especially on Friday when we are going to get the release of the data for the jobs report, which will therefore indicate whether or not there is some more economic weakness, and this will in turn decide whether or not we get another 50 basis points from the Fed in November. Now, other things that are taking place this week, earnings season is starting to kick up again, as we can see some very big names. We have Nike reporting tomorrow after close, as well as some other companies. We also note that when we do look at the Fear and Greed Index, we are now moving very closely into extreme greed territory, which is going to be interesting, especially with the volatility that we do expect to come from the US election in the next few months. Now, in today's episode, we are looking at 8 undervalued dividend stocks that we believe are great considerations for the portfolio in the month of October. As always, we'll look at each one's historical performance. We're going to touch upon their earnings, how they performed over the last few quarters, expectations moving forwards. We're going to take a look at these companies in detail, their dividend safety, as well as other metrics. For example, we always like to touch upon dividend yield theory, as well as looking in detail at some of their very important metrics, their free cash flows, their sales growth, ROIC, and ultimately this will end up leading to our valuation models, where we will effectively get to our own intrinsic value. We're going to talk about our margin of safety for each one of these stocks, as well as what Wall Street see in terms of upside for over the next 12 months. Now, before we start off, we just want to let you know we have released our latest free weekly article where we run through what's happened in the market, as well as stocks that we are considering for our portfolio that look to be undervalued and going into quite some depth. So do click on the pinned comment below where you can sign up and read straight away. And you will also be able to access our 36 undervalued stocks for the month of October for your consideration, where we do take a look at each one in quite some detail and discuss those that sit within our own portfolio. On top of that, you will be able to access 22 undervalued dividend stocks that have the most upside according to Wall Street. So as we said, click on the pinned comment below and you can start reading straight away. Now, the first stock we're covering is PepsiCo, where we get a double buy rating from Wall Street and Quant. We get the hold from Seeking Alpha, and this is a company that is trading pretty much bang on in the midpoint of the 52-week range, a fairly attractive forward yield, 3.2%, and a forward P of 20.9. Bear in mind, for context, S&P right now around 23.5. We also note over the last 12 months, pretty much flat performance, only up by 0.47%. Over the last 10 years, up around 82%. We can see all-time highs sitting around a year ago at $196. But over the last 10 years, even with reinvesting the dividends, it has marginally underperformed the S&P 500. In terms of their earnings, while moving forwards, they are anticipating the next 4 quarters to show some nice increase to the EPS year on year. We also do note over the last 4 quarters, they have outperformed analyst targets, which is great to note. 100% track record over the last year, giving us faith when we do look at their expectations for the next few years that they will be somewhat accurate. 8.7 EPS, with the forward P estimated to come down to 19.5 in December 2025. Now, taking a look at their dividend safety, we have a score of 93, very safe. Yield, as we mentioned, very attractive, and we will run through the valuation we have here with very nice growth, 7.1% in February this year. As always, bare minimum on this channel, we want 4% just to keep up in line with inflation. Now, very safe score was reaffirmed the end of July, and ultimately what this means is that a dividend cut for PepsiCo is highly unlikely. With each 8 of these companies, we're going to look at some key metrics, really focusing on how it performed during the 07-09 Great Recession. For PepsiCo, well, they increased their dividend. They had above average growth, negative 0.5%. S&P was negative 12, and they also significantly outperformed, negative 35%, the S&P 500 itself, negative 55. Now, very nice to note, consistent in terms of those dividend increases, 7% over the last 5 years, and we know double-digit increase at 11% over the last 20. On top of that, what we do love about this company, it has now recently become a dividend king with 50 plus years of consecutively increasing those dividends. Now, one thing that is fairly new to this channel, we take a look at this model where it does compare it to the 5-year average PE, and we do get in today's episode for PepsiCo an undervaluation signal. Just bear in mind, we're going to do our own valuation process shortly for each one of these companies as well. So when we zoom in over the last year, this blue bucket essentially shows us what the expected intrinsic value of this company is, and over the last year we can clearly see, and in fact in the more recent period, that PepsiCo is trading below that fair value, so we do understand that undervaluation signal. And the other model that we typically refer to on this channel, dividend yield theory, which shows us a company is undervalued when the current yield sits above the 5-year average, 3.18 as we can clearly see above the 2.82. In fact, we get a double undervaluation signal. Forward P of 20 sits below the 5-year of 24, and when we compare it, it is sitting marginally higher than the consumer staples sector of 18.4. Just bear in mind we don't look at any one of these models in isolation, we will conclude towards the end. Now, we'd like to draw your attention to the free cash flow payout rather than the earnings, as it is susceptible to manipulation by management through accounting. Below 70% for consumer staples. Our general rule here on this channel is around 60%. It does give us faith then that management are able to offer those double-digit increases we ideally want to see. Now, a few red flag indicators from their past: triple digit, so 111% in 2022, indicating that that year management paid out more in dividends than they generated in free cash flow. Not something you could see by purely looking at the earnings data. Now, 86% in 2023, it's okay, better than the previous year, it has come down, but what is really nice to see is that over the next 12 months, it is anticipated to come down to around 72%, which is more in line with the industry maximum that we want to see. We then move on to free cash flow per share. As always, consistent increases over the longer term. Now, it has increased from a purely standpoint perspective, 507 in 2014, 576 in 2023, but very inconsistent. So just bear in mind, this isn't a type of company that will be increasing massively their free cash flows. Nice to report though, over the next 12 months, anticipated to increase to 758. Then we get to sales growth, where we want 3 to 7%. Remember, 3 to 4% at a bare minimum, just to keep up in line with inflation. Something we can clearly see they have been doing over the last 5 years. Ideally though, we want to see that a little bit more consistently. Looking from a numerical perspective though, we can see nearly 50% growth over the last 10 years, 67 billion to 92. And what they have done is returned a little bit of excess cash to shareholder pockets through those share buybacks, but understand it is very, very inconsistent, and in fact they have gone years without doing any movement, so don't bank on this. We do typically see this as an added bonus. We then move on to one of our favorite metrics, the ROIC. 10% or more, or 12 for consumer staples. Give us faith, management are able to effectively allocate their capital consistently year on year. We love to see this in the high teens to low 20s, 20% on a trailing 12-month basis. That is a great sign to note. And operating margin, we always want to see at a bare minimum 16%. Now, it does straddle around that, so it isn't too bad. The one thing we like to keep our eye out on this channel are companies that have increasing margins, giving us that operating efficiency whilst increasing their top lines. Free cash flow margin pretty much every year above 7%, so no worries there. 8% as we can clearly see on a trailing 12-month basis. This then leads us into the net debt to EBITDA, referring to the earnings before interest, tax, depreciation, and amortization. Remember, this correlates to balance sheet strength and dividend safety, and below 4 is what we want to see. Remember as well, numbers below number of years it would take the company to pay off all of their debt net of cash on hand. So quite a few positives to note. First one, it is below 4 consistently. The second one, from the highs of 2020's point of 2.66, it has started to come down, anticipated to come down to 1.9 over the next 12 months. So balance sheet does look okay, as well as that dividend safety. As we saw, it had a very safe dividend score. So overall, Pepsi does look like a strong stock. And then we're going to run it through the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $194, how we got this is we ran it through 3 models. Now, typically on this channel, we do in-depth dives looking at each model, the inputs, the outputs. Today, we're going through 8 dividend stocks, so let's get straight to it. Intrinsic value 194. As always, margin of safety on this channel at 10% as the starting point. We use that, execute if it hits our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that for PepsiCo, well, it is a buy up to around $175. Then we keep going till it's near the trading price, and it isn't at the 15% MOS level yet at 165, but it isn't too far off, so sitting somewhere in today's episode between the 10 to 15%. For me, this is one that you could argue to dollar cost average in when it does get to around that 165 point. For those that want to see at 20% around 155, at 25 around 146. And also remember, it does currently pay a fairly attractive dividend with very nice increases that we've seen historically, as well as being a dividend king. In terms of Wall Street, they do see upside, although not too much, around 10% over the next year. Their price target is $187, and this company can be seen as very strong for those that like to use the income or want a bit more stability to their portfolio. As always, do give us your thoughts in the comments below as we go through these companies today. The next one we're moving on to is Novo Nordisk. Now, this is one we have covered not too long ago, but it is down more than 2%, and we do believe it to be high quality, so we have added it again in today's episode. We have a double buy rating with the hold from Quant. This one is trading in the moving towards the lower end of the 52-week range with a forward P of 35.2 and a forward yield of 1.2%. Now, over the last year, it is up around 28%, and over the last 10 years, this is up significantly, 441%, and has outperformed the S&P 500. Now, in terms of their earnings, well, the next 2 quarters, they're anticipating strong double-digit EPS growth, and out of the last 4, unfortunately, they did miss the more recent quarter by 7 cents, but the previous 3 to that, they did beat, so a 75% track record. And moving into December 2025, if they hit that EPS estimate, the forward P will come down to around 28, but as we have seen previously, companies in the pharma industry that are of high quality do tend to trade at a very high premium. Now, we have another very safe dividend score, although this one has 99, the highest score obtainable, and we're going to run through the model. Very nice to note, though, their more recent increase to the dividend was sitting at 52%. Now, when we take a look at the last recession, they did increase the dividend. They had positive recession sales at plus 6.1, and they severely outperformed the S&P, negative 27%. We love this dividend growth company, 52% over the last full year, 18 on average over the last 5, with 21% over the last 20, and we can see they are a dividend aristocrat, increasing those dividends for more than 25 years. Now, when we take a look at the valuation, as we can see over the last year, this is now looking like it's falling within its intrinsic value. Pretty much the last 12 months, it has been trading above fair price, which is why we have brought this in, not one we have looked at significantly, given the fact that it has historically traded at quite a massive premium. We do, however, believe it is a very high quality company, and as it does start to drop in terms of share price, we do want to draw it to your attention. Now, we get a reasonable valuation signal with the yield not too far off the 5-year, as well as the same to be said for the forward PE, although we do note it is significantly higher than the healthcare sector of 16.9, but when you do look at the numbers and the metrics it produces, it would be very difficult to argue that it doesn't deserve its premium. Question, as always, as an investor, what is the premium that you are willing to pay? Now, free cash flow payout pretty much below 60% for the majority of the last 10 years, 60% in 2023, expected 52% over the next 12 months. And when we take a look at the free cash flow per share, we can see it has more than tripled over the last 10 years, 5.22 to 15.6, with the upward trajectory expected to continue over the next 12 months into $18.50 per share. We then move on to the sales growth, top line revenue, last few years looking very, very strong at double digit. And when we do zoom out to look at over the last 10 years, we can in fact see this company has more than doubled their top line from 89 billion to 232 in the more recent period. On top of that, they have done some very nice share buybacks, in fact 5.26 billion in 2014, down to 4.48. And remember, when companies do share buybacks, it ultimately gives you a larger portion of control of the company that you are invested in. Now, you will find it very difficult on this channel to find metrics that are better in terms of the ROIC for NVO than any others. We can clearly see 72% in 2023, 66% on a trailing 12-month basis, and these high numbers have shown through over the years at a very, very consistent basis. So we do love this about this company. We also like the very attractive margins, above 12%, they hit that consistently with a little bit of operating efficiency, 39% in 2014, 45% in 2023, and the same to be said for the free cash flows, looking very strong every single year, 30% in 23, 26 on a trailing 12-month basis, making it incredibly attractive to shareholders as well as those who are looking to add. The good metrics don't stop there. On the net debt to EBITDA, pretty much 0 every single year, 0.1 in 2023, 0.06 over the next 12 months. Goes to show you that they have a very strong balance sheet and absolutely no surprises why that dividend safety score does sit at 99. We then have it in the valuation model at $134. We do know Wall Street have a higher price target at 144 with upside of 23%. And when we do run it through our MOS calculation, at 10% a buy at 121, at 15% around 114. So it is around $3 shy from that 15% MOS. So we would say right now between 10 to 15%. For those that are looking around the 20% level at 107, this is definitely what I would say a very good company to consider in the portfolio. And for those that want to see it 25% around the $100 mark. As we said though, in conclusion, 10 to 15% with 23% expected from Wall Street over the next 12 months with some very, very nice dividend growth over the last few years. We then move on to Chevron with a double buy rating and a hold from Quant. This one is trading in the lower end of the 52-week range with a very attractive yield, 4.5%, a low forward P at 13.2, and we do note over the last 12 months it hasn't had the greatest period, down 15%. Over the last 10 years, up 27%, but remember this is if you had bought this company 10 years ago. For example, the COVID lows of $60, you would be up more than double the current value you had invested. In terms of looking at their earnings, well, we do know moving forward, something to bear in mind, oil and gas, very cyclical industry. Out of the next 4 quarters, they are anticipating 3 of them to be negative, 1 being positive. And over the previous 4, they have in fact missed on 2, so a 50% track record, with the more recent quarter being a fairly sizable miss to the EPS. However, moving forwards year on year, they still expect increases, and that forward, if they hit that 12.45 EPS, the forward P will come down to around 11.7. Nice to note, another very safe dividend score, and we can also see a very attractive increase at 7.9% in February this year. In terms of taking a look at this company's key recessionary metrics, while they increased the dividend, they had massive below average growth, negative 43%, whilst also outperforming the S&P, negative 34%. As we said, very attractive growth, 7.9% this year, 6% over the last 5, and 7% over the last 20, and that is very attractive because this company is not only a dividend aristocrat with 36 years of consecutive increases, but has been paying a dividend for the last 112 years without a reduction. We then take a look at the average dividend yield theory valuation. Now we do get a reasonable signal here. When we do break it down in terms of looking at the expected price over the last 12 months, we can see it is trading right there towards the lower end of that blue bucket. Then we take a look at dividend yield theory, where in fact we do get an undervaluation signal on the yield, 4.49 above the 5-year 4.19, but we do in fact note that the forward P at 13 isn't dissimilar from the 5-year average of 12, and not too dissimilar as well from the energy sector of 12.9. Now, when we take a look exactly at the free cash flow payout, as we said, the volatility of the industry will show through the numbers, but the last few years have been fairly decent, around the 40% level we want to see as a maximum, with the next 12 months signaling 47% for Chevron. Then we get to the free cash flow per share, and for a volatile cyclical company, nice to note that only 3 of them have been negative. In fact, over the more recent year, 1060, nice to report the next year is expected to increase by 30% to around 13.7 per share. Then we get to the sales growth, where you can clearly see the cyclicality. In fact, out of the last 10 years, 6 of them, including 2023, have been negative, and that does show up when you do look at it from a numerical perspective, from the highs of 192 down to the COVID lows of 94, before seeing the more recent year at 195. Now, this company has done both share buybacks as well as share issuances, so something just to note, on a year-on-year basis it does fluctuate, but over the longer term they have bought back some very marginal shares as the net position. We then look at ROIC, looking fairly attractive over the last few years. Above 8% is what we want to see. That is what we get. And we note 12% over the last 12 months. Then moving on to the operating margin, the last 3 years looking not too bad, around the 12% level we want to see for the industry. Same to be said for the free cash flow margin, although we do get that for a longer period, around the last 7 out of the 10. Finally, we get to the net debt to EBITDA, where we want to see below 1.5 for oil producers. Over the last 3 years, that is what we see, 0.4 in 23, 0.45 anticipated over the next 12 months, so we understand why the dividend is very safe and very nice to note, especially given this company has been paying dividends for such a number of years. We then move on to the intrinsic value at $173, where we do run it through the MOS, 10% a buy at 155, at 15% at 147, which isn't too far off where the company is right now. At 20%, you would have to wait for 138. So right now, as we can see here, this company does trade at a 15% margin of safety, with Wall Street giving this some very attractive upside of 23% at a 179 price target. Remember, you are also getting a very attractive 4.5% yield, whilst this is a company that does tend to grow its dividend above the inflationary rate. We then move on to the Hershey company with one buy rating from Seeking Alpha and a double hold. This one trades in the mid to lower end of the 52-week range with a yield of 2.83%, a forward P of 20.42, and as we can see over the last 12 months, not the greatest, down 4.5%. The increase in the prices of cocoa has really hit this company over the last few years, and as we can see here, over the last 10 years, up 106%, and it has been downward trending since May last year, 23, where it hit $275. Now, in terms of their earnings, we notice out of the next 4 quarters, 3 of them to be positive, and out of the previous 4, they did miss on one of them, giving them a 75% track record, although we can see it was a sizable miss by 18 cents. We do also have to point out that December 2025, they are expecting a reduction to the overall EPS, which will bring up the forward P marginally higher to 20.8. In terms of dividend safety, well, a score of 80, so it does look to be safe, and very attractive dividend increase of 15% in February this year. Now, in terms of how they performed in the last recession, well, they actually maintained the dividend, didn't increase it, didn't cut it. They pretty much had flat recession sales, whilst also outperforming the S&P with their negative 30%. Also, nice to report, over the last year, over the last 5 years, and the last 20 years, they have been increasing those dividends at a double-digit rate. And unfortunately, whilst they have only been increasing those dividends for the last 14 years, we do note something very, very good, which they have been paying a dividend for the last 94 without a reduction. Hopefully, we can see these dividend increases continue over the longer term. In terms of the valuation, based on the forward PE, when we zoom into over the last year, it has been trading pretty much every single day or every single month right below the fair value. So as we can see, and as our valuation will show, this does look to be undervalued. We also notice a massive undervaluation signal on dividend yield theory, as well as the forward P of 20 lower than the 5-year rolling of 24, although we do note it is marginally higher than consumer staples sector of 18.4. In terms of free cash flow payout, well, below 70% for consumer staples, pretty much below that every single year. 59 in 2023, expected the same over the next 12 months. So we would like to see a nice attractive increase to the dividend moving forwards as well. In terms of free cash flow per share, well, it has pretty much tripled over the last 10 years, expected to increase again over the next 12 months, but year to year we do have a little bit of inconsistencies. We then move on to the sales growth, where we do notice some years very poor, below the 3% minimum, but over the last 3 years looking very strong. We do want to point out that on a trailing 12-month basis, we just see the 1% lower than inflationary level. We then can see from a numerical perspective pretty much 50% increase over the last 10 years, and we do also note they have done some share buybacks, but very, very small, maybe 1 million a year, so don't expect too much as an investor moving forwards. We then can see the ROIC, whilst it has been decreasing well above the 12% minimum, and over the last 6 to 7 years it has been trading in the mid-20s, which is always very nice to see as an investor as well as prospective investors. In terms of margins, well, we also get that essential margin operating efficiency, where it's gone from 20% in 2014 to 23% in 2023, and the free cash flow margin, nothing really to argue here, looking very attractive on a very, very consistent basis. Finally, we move on to the net debt to EBITDA. Below 4 is what we want to see, below 4 is what we get. 1.49 in 23, a small increase anticipated over the next 12 months. Nonetheless, still looking good. We understand why we have that safe dividend score, and the balance sheet does look okay. We then move on to the intrinsic value at 215 with a 10% MOS, a buy pretty much at the current price. Depending on whether or not this is sufficient, we can see at the 15% you would have to wait at 183, at 20% around 172. So today's episode, Hershey trading at a 10%, a fairly attractive yield, very nice double-digit increase moving forwards, and with the expectation of cocoa prices coming down, we do like to think Hershey moving forwards will surprise a lot of investors. We also know the forecasted by Wall Street at 212, giving it 10% upside. One of the reasons why we did in fact see today them giving it a hold. As always though, do give us your thoughts in the comments as we do move along. We then move on to AWR, American States Water Company, with a double buy rating and a hold from Quant. A very interesting fact about this company, it is the company that has increased dividends by the most amount of years out of all the other companies. We will come on to the actual years, but very interesting to note. In terms of yield, well, 2.25 forward P at 27.25, trading towards the upper end of the 52-week range, up around 6% over the last 12 months, over the last 10 years, outperforming the S&P, up 169. We also note moving forwards out of the next 4 quarters, 2 of them they expect double-digit EPS growth, but they did miss their more recent quarter, although marginally, giving them a 75% track record, and we can ultimately see the December 2025 forward P anticipated to come down just below 25. We also love the very safe dividend score of 98. We have that undervaluation signal with a very attractive dividend increase just over the last month at 8.3%. In terms of looking at this company from a recessionary perspective, well, they increased the dividend during the 07-09 Great Recession. They had plus 2.2% sales as well as outperforming the S&P. And in terms of dividend growth, very consistently offering very attractive increases to the dividend on a year-on-year basis. And as we mentioned, they've been increasing those dividends for the last 69 years. That is something that no other company has managed to accomplish. So again, it does make this company one of a kind. Then when we take a look at that valuation based on the dividend yield theory over the last 5 years, we get an undervaluation signal, which when we do look over the last 12 months, it pretty much has been trading below its fair value on a very consistent basis. However, when we take a look at dividend yield theory, we also get confirmation, a double undervaluation signal, both on the yield as well as the forward PE. However, when we do compare it to utilities as a whole, it does trade much lower at 18.2. Now, one thing to note with utility companies, a lot more volatile in terms of free cash flow, so we do ignore it and we draw your attention to the earnings. Below 75% is what we want for water utilities. Below 75 is what we get. 58 in 23, 58 expected over the next 12 months, so looking very positive. Then we get the earnings per share where we get those increases fairly consistent over the longer term, nearly double from 157 to 285. Nice to report over the next 12 months, anticipated to increase as well to 321. When we do look at sales growth, understand as well a little bit of cyclicality within this industry, which is why we get 5 of the last 10 years being negative, although nice to report 2023 very strong, up 21%. And when we do look at it from that numerical perspective, we can see it has been increasing. Similar to other companies we have reviewed today, they've both diluted your position as a shareholder as well as buying back shares. We do know very inconsistent, but over the last 10 years, ultimately, they have done some share buybacks as the net position, which is very good because utility companies tend to issue a lot of shares to fund a lot of their growth expenditures. Then we move to ROIC, which really for this industry we bring down to 7.5. They've done very well on a very consistent basis, 11% in 2023, and also happy to report on an operating margin basis, not only consistently above the minimums, but very strong operating efficiencies, whilst also increasing their revenue over the longer term. Then we get to the net debt to EBITDA. Now below 5.5 is what we want to see. One thing we would say, it has been increasing, not the greatest sign, not something we really want to see, but nice to report from the highs of 2022, it has come down, a marginal increase expected over the next 12 months, still below that 5.5 that we want to see as a maximum for water utilities. Now in terms of our intrinsic value at $95, at 10% a buy at 85, at 15% pretty much bang on. So for a company right now, we see 15% MOS with Wall Street indicating 13% upside with a $90 price target. Perhaps one to consider if you don't have a utility company or you are looking for something different than the typical companies you tend to buy. Now, in terms of margin of safety, for those that want to see at 20%, a buy at 76, and at 25%, around $71. As we said, though, today's episode pretty much bang on a 15% MOS. We then move on to our first REIT, REXR, Rexford Industrial Realty, with a strong buy from Seeking Alpha, a buy from Wall Street with a hold from Quant. This one trades pretty much in the midpoint of the 52-week range, a yield of 3.31%, a P to FFO of 21.4, and over the last year, pretty much flat 2.1% up. Over the last 10 years, significantly outperforming the S&P, up 259%. We also like to report that over the next 4 quarters, anticipating some nice growth to the earnings per share, and over the last 4 quarters, 100% track record, either in line or at least beaten, even if only marginally. And with the FFO expected to increase, the price to FFO, the funds from operations, expected to come down to 19.36 in December 2025. Now, dividend safety, very safe score, always great to see. An undervaluation signal, as well as very, very attractive increase, 9.9% in February this year. And as we can clearly see, in terms of dividend growth, it isn't the first time they have done very attractive increases. 19% on average over the last 5, 22% over the last 10 years. And we can see, in fact, they have been increasing those dividends for the last 10. When we take a look at that valuation, as we can see that undervaluation signal, we note that over the last year, and by quite a massive gap, they have been trading well below their fair value. And when we do compare it to dividend yield theory, we get pretty much a very same, or in fact a confirmation of that conclusion. Massive undervaluation on the yield and massive undervaluation on the price to adjusted funds from operation, although we do see it trading higher than the real estate bucket sector at 17.4. Then when we move on to the free cash flow payout, very similar to utility companies, we don't tend to look at this given it is a lot more volatile. We want the adjusted funds from operation payout below 90%. That is exactly what we see consistently. 88 in 23, anticipated 83 over the next 12 months. In terms of the AFFO per share, well, pretty much consistent increases on a year-on-year basis, and that upward trend is expected to continue 201 over the next 12 months. In terms of sales growth, well, for REITs, 5 to 10% is what we want to see, and that is pretty much what they have delivered. Not only that, by increasing their top line, but we can also see the AFFO per share growth looking very strong, nearly double digit every single year, which is ultimately what you want to see as a shareholder. And clearly we can see that growth from a numerical perspective, but one thing we have to point out with REITs, in particular REXR, they do dilute your position at a very rapid rate, as we can clearly see, but ultimately understand they do this because they don't retain a lot of that cash flow due to paying the majority out as dividends. Now, we always want to see ROIC at 10% or more for majority of companies. For REITs, 3 to 5%. While they haven't hit that on a consistent basis, nice to note it has increased, now sitting at 3%, which ideally we would want to see that as a bare minimum moving forwards. In terms of operating margin, always a great sign to see that operating efficiency and pretty much increasing that margin on a continuously year-on-year basis. And the net debt to EBITDA, the final metric for this company, below 5.5. It has been decreasing from the highs of 2014, 4.06 in 23, a little increase anticipated over the next 12 months, showing us that there are no surprises in terms of balance sheet strength as well as that overall dividend safety. So how about the valuation? Well, our intrinsic value of 63.46, when we do put it through the MOS calculation, 10% a buy at $57, 15% a buy essentially at 54, and at 20% we can see right now that is where we see this company. For those that want to see 25%, it would be a buy at 48. So 20% MOS in today's episode for REXR with a fairly attractive upside of 16% with a price target of $58. As always, let us know if this is one you have been buying, or maybe you're adding it to the watch list, or in fact REITs isn't an industry you want to add to your portfolio. We then move on to one of the highest quality companies we are looking at today, MSCI, with a double buy from Seeking Alpha and Wall Street, a hold from Quant. This one does trade at the upper end of the 52-week range with a yield of 1.1% and a forward P of 38.84. Now, over the last 12 months, it is up around 14%. Over the last 10 years, up massively 1,112%. And when we do take a look, looking very consistent, strong EPS growth anticipated over the next 4 quarters, and they have beaten analyst targets over the last 4. As we said, if they do hit that EPS estimate, given how consistently they have been, we would expect that to be the case. The forward P will come down to around 34.3. Now, we have a safe dividend score at 61, an undervaluation signal, as well as a very strong dividend increase of 16% in January 2024. Now, in terms of the last recession, we also note they did have above average growth at 1.5%. However, they didn't pay a dividend during that time, so no comparative data. Not just this year was there a very attractive increase, but 24% on average over the last 5 years. And as we can see, they have been increasing those dividends for the last 9 consecutively. As we mentioned, that undervaluation signal over the last year, what we do note is that sometimes it has been hitting inside the fair value bucket, but for the majority, or in fact the last 6 months to say the least, this has been trading well below that intrinsic value. In terms of dividend yield theory, we also get that sign there, although you could argue marginal, 1.11 above the 0.995 year rolling, as well as the forward P, 36.6, sitting below the 5-year average of 41. We also note that it does sit much higher than the financials 12.2 sector, but as we always say, a lot of companies, especially MSCI, does deserve the premium, and as we will come to see how much of a premium we truly believe. Free cash flow payout then below 60%, that is what we see every single year, which is why we do get those very nice increases. There are no surprises, it all does make sense as to why this is a high quality company. And the free cash flow, I mean, that is very strong, very consistent. In fact, nearly 7 times growth over the last 10 years, expected to continue over the next 12 months as well. And when we look at that sales growth, again, very attractive to note. Whilst it may not be massive double-digit increases every single year, it is very consistent, high single-digit, low double-digit percentage, which ultimately, when we do look at it from a numerical perspective, we can see they have 2.5 times their top line over the last 10 years. What we also note is they have done some returning of excess cash to shareholders through those share buybacks, some years a little bit more consistent than others, but as always, a nice bonus to say the least. ROIC also been increasing over the longer term, 14% in 2014, 35 in 2023, 36 on a trailing 12-month basis, so lots to love about this company. And we also get that very strong thing that we always want to see, which is operating efficiency. Majority of companies that we review nowadays all increase their top line, but not all, like MSCI, have that operating efficiency. Free cash flow margin, I mean, this is a free cash flow machine in the 40s over the last 6 years. That is what we love to see on this channel. We then move on to the net debt to EBITDA. Below 3 is what we want to see. That is what we get. 2.7, a little bit too high. No surprise then why it's a 61 safe dividend score, but nice to report over the next 12 months, it is expected to come down to 2.35. So when we run it through the valuation, our intrinsic value of 627 is a little bit lower than Wall Street. They have 675, their upside of 18%. And when we do run it through our margin of safety, at the 10% level, we get a buy at 564. So it's around $10 shy. It could be something we see over the next few days or over the next few weeks. But at a 10% margin of safety, this is one you could consider to maybe dollar cost average in. As we said, it is a very strong company, very good metrics. And for those that want to see the 15% around at 533, we would say this is definitely one that we will look to add to the portfolio. But as of right now, it is near that 10% margin of safety with 18% upside according to Wall Street. We then move on to the semiconductor giant ASML with a double buy rating and a hold from Quant. This one trades in the mid to lower end of the 52-week range, a forward P of 40 with a yield of 0.78%, and we do note some massive growth over the last 12 months, up 46%. Over the last 10 years, a massive outperformance of the S&P, up 764. We also note some massive growth expected to the earnings per share over the next 4 quarters, and nice to report some very large beats in the previous 4, giving them that 100% track record. And as we can see, big things are expected. Just look at that growth from 2024 to 2025, which will ultimately bring the forward P down to around 25.55. Now we get a very safe dividend score with an undervaluation signal with a little bit of a mediocre increase at 4.8% just a couple of months ago. Now, last recession, we have to let you know they did in fact cut the dividend, didn't increase it, didn't even maintain it. They had below average growth, and they ultimately had a near S&P return at negative 55. As we said, very poor increase given the fact that over both the last 5 and the last 10 years, they did increase those dividends at a double-digit rate. However, having said that, they have been increasing those dividends for the last 14 years. Now we have that undervaluation signal. When we do zoom in and look at it from a 1-year perspective, what we do in fact note, some of the year it's been trading in its fair value, some year above fair value, and right now, as we can see, right at the bottom, if not just slightly out of that intrinsic value calculation. In terms of dividend yield theory, we get a reasonable valuation signal based on the yield with a slight undervaluation based on the forward P of 30, lower than the 5-year rolling of 34. We do also note it does sit higher than information technology, which sits at 26.3. In terms of the free cash flow payout, well, no surprises why this year they did a very mediocre increase, given the 74% free cash flow payout. Every single year before it's been below 50. Nice to report over the next 12 months, expected to come down to around 14%. We then move on to the free cash flow per share, where remember, similar to oil and gas, semiconductor is also a cyclical industry. Nonetheless, we do see growth over the longer term, just very inconsistent. Massive growth, as we can see here, expected over the next 12 months. In terms of sales growth, well, double digit nearly every single year, 30% in 2023, 14% in 2022, although on a trailing 12-month basis, negative 2%, something just to consider. Nonetheless though, very impressive growth from 2014 to 2023. They've also done some share buybacks on a year-on-year basis, but fairly inconsistent as we can see here, so not much to discuss. ROIC not only looking very strong, but the last 3 years have been very impressive in the mid to upper 40s, 40% on a trailing 12-month basis, and the margins also looking very attractive, above 16% for the industry, 26 in 2014, 33 in 2023, and the same to be said for the free cash flow, looking very good throughout, but we can also note some of the inconsistencies when we do take a look on a year-on-year basis. And the best balance sheet we have seen today, zero right across the board. It won't even take ASML 1 day to pay off all of their debt net of cash on hand. Now the intrinsic value at $1,152 does come from the DCF model. Now we can show you this for today. Now it has the free cash flow year on year. We have the average growth at 35%, and what we've gone is for 3 different rates, a low, medium and high. At the 30%, which is in fact lower than the average of the last 10 years, getting the discount rate, we have the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, meaning that there's 27% upside from the current valuation. As always, these numbers are essentially subjective, so you can grab a copy of the model by clicking on the pinned comment below, running through your own numbers, whether it's for ASML or any others. And for transparency, as always, to show you, for those that believe it should be lower, 25% the intrinsic value at 831, giving around negative 1% downside. For those that believe it should be more in line with the average, at 35% we can see intrinsic value 1584 with upside of 47%. Nonetheless, we will take through the 30%, and as we can see, a nice margin of safety in today's episode. 10% a buy at 1037, at 15% at 979, at 20% around 922, and in today's episode we can see at least a 25% MOS up to 864. For those waiting at 30%, it would need to see around 806. So today's episode between a 25 to 30% MOS, with Wall Street very bullish, as we can clearly see 40%, their price target $1,173. Continuing the theme of semiconductors, we have Qualcomm with a double buy signal and a hold from Quant. This one does trade in the midpoint of the 52-week range, a yield now at bang on 2%, a forward P of 17, and over the last year up 56%, over the last 10 years outperforming the S&P up 139. We also note, similar to ASML, looking positive over the next 4 quarters, as well as outperforming analyst targets over the previous 4, giving them the 100% track record, with the forward P anticipated to come down to 15.14 in September 2025. We also get a safe score of 80 on the dividend, a reasonable valuation, as well as a 6.3 increase to the dividend in March this year. Now, in terms of the last recession, well, unlike ASML, they increased the dividend. They had negative 7% sales, whilst also significantly outperforming the S&P, negative 21. As we can see here, pretty consistent in the increases over the last 5 years and the more recent. However, over the last 20 years, on average, they have been increasing those dividends at 20%. And we can see they've been doing this for the last 20 years on a consecutive basis. Now, in terms of valuation, we get the reasonable valuation signal here today, where it does trade pretty much in the middle of the blue expected intrinsic value bucket. When we take a look at dividend yield theory, we also get pretty much a reasonable valuation signal, both the yield as well as the forward PE trading fairly similar to the 5-year averages, although we do note, unlike ASML, this does trade significantly lower than the information technology sector at 26.3. So in terms of the free cash flow payout, below 50% is what we want to see. Pretty much what we get over the more recent years, 31% again expected over the next 12. We then move on to the free cash flow per share, where we see nearly double over the last 10 years and expected to increase to $10.80 over the next 12 months. Again, cyclicality showing through the numbers. 5 of the last 10 years, including 2023, we actually get negative, in fact negative 19% in this year. And we can see from the numbers not looking the greatest in terms of consistent growth. So something to consider, maybe use it as an element of your margin of safety. And in terms of shares outstanding, they do a lot of reduction, a lot of share buybacks, but again, very, very inconsistent. In fact, over the last 4 years, it has moved very, very minimally. Then we get to the ROIC, looking very strong for this industry, around 23% in 2023, 25% on a trailing 12-month basis, so no worries whatsoever when looking at this metric, which we do believe is a very important metric to consider. We then move on to the operating margin, where above 16% is what we want to see. That is what we get, just no signs of operating efficiency. Free cash flow margin, even though very, very inconsistent, looking very strong, 34% looking good on a trailing 12-month basis. We then move on to the net debt to EBITDA, which also looks equally as good, below 1.5, pretty much decreasing, 0.35 in 23, 0.1 anticipated over the next 12 months, so a very, very impressive balance sheet. No worries with that dividend safety. Now, our intrinsic value of $217, a little bit lower than Wall Street. Their price target, 221. They see upside of 30%. And when we run it through the MOS calculation, well, at 10%, a buy at 195. At 15%, a buy at 184. And as we say, we keep going till it's near the current trading price, 20% up to 173. And not right now at the 25% level. So today for Qualcomm, if you are executing, you're getting a 20% margin of safety, with Wall Street indicating 30% upside over the next 12 months. As always, give us your thoughts whether or not you are adding to any of these over the next few weeks. If you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified as these videos drop. And also don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below, as well as joining us in the Patreon, where we do discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.